we're in the midst of what is a very choppy earnings season for a lot of companies. And I've talked about this in other contexts before and in speaking with clients, especially on the professional services side. But indicators of a recession, or at least a pullback, typically show up initially, at least from my experience and from conversations that I've had with my mentors and people that I know, that it'll show up in two places. So the first, of course, is marketing cuts. The easiest place that companies, even though I'll posit, of course, that it's maybe the most foolish place to pull spend in the face of a slowing economy. But marketing is typically the first place, and then the second is in headcounts. So companies will start to do layoffs when they anticipate or forecast slower economic conditions. And so I think this is what we're starting to see now. We've had, I think it's officially now 2 consecutive negative growth quarters for the U.S. economy, so like a technical recession essentially. But we already were seeing this in the way that the large cap tech stocks, the large advertising companies were reporting slowing revenue growth, so to speak. And so, you might say, okay, well, YouTube's revenue grew just 5%, according to the headline here. And that's still better than zero, right? That's still growth. But Wall Street was estimating that YouTube would grow at 7%. So this is coming underneath the estimates. And another, I think, really interesting stat is that Alphabet, so Google's parent company, and this is the one that owns YouTube as well, their revenue, while it increased 13% year over year in the second quarter, the quarterly results represent the company's slowest pace of growth in more than 2 years. So you're starting to see even a company like Google, which if you run a business or if you do anything in marketing, you know that it's basically a tax that you have to pay to play in the game of e-commerce, at least. If you're not on Google, for the most part, you're invisible in two senses. So either you haven't done the requisite work or investment to get onto the first page of Google, or if you're not paying to be in search to be at the top of the search results, you're just not visible at all. So Google has become a little bit of a tax that companies have to pay. And if you're starting to see dwindling revenues on that side of things, I think it probably is a little bit more than a canary in the coal mine. And I've been using that a lot with clients in terms of some of the stuff that we've been doing around PR and getting data in. But it shows that, and the data we've pulled has shown that the consumer's been slowing spending for a couple of quarters now. And I think this is what we're starting to see is it hit the top line of these companies in a way that's substantive, in a way that is indicative of something happening in the economy. And I think you pair that up with all the news lately, at least in the tech sector, which is the one that probably overextended over the last 24 months with all the extra money. All the layoffs and all the reductions in force, that you're starting to see some parts of the economy really pull back hard. And the fear is that this then starts to creep over to companies that maybe aren't affected, but see this as kind of the traffic light, so to speak. And they see these large cap tech companies, these social media companies, Shopify, for example, another kind of e-commerce platform that is just been ruined. No, right? Ruined is maybe a bit tough, but it's just been pummeled in the stock market with their market cap over the last 6 months or so. And it's all to do with just pullback in spending. And James and I have talked about this, James Phillip and I have talked about this a lot on his channel and in other platforms, where the idea that companies are making decisions based on inflated demand, thinking, okay, well, now that the idea that you could gauge demand based on an environment where everybody was flush with cash, there's stimulus in the system, 0% borrowing rates. It's not insanity, but it's craziness in terms of making decisions that impact a lot of people. And to think that you could sustain those growth rates, I think what you're going to find now over the next 12 months is you're going to see who the real shrewd operators are in business. You're going to start to see who Who are the ones who actually understand how to manage their balance sheet, how to manage cash flow, how to manage things like projecting out growth and making sure that you're not making projections based on just ridiculous environments of enormous cash where everybody is flush with it. So you're going to be able to see who are those that at least have lived through multiple recessions, or I've seen a couple, to where they know that, okay, you can't just make big decisions. And I think that's another interesting thing that I've been thinking about lately, and it's one that it's a bit of a side topic to what we're talking about here, but there are a lot of CEOs out there right now. There are a lot of leaders of companies, because of the way the environment has been over the last 15 years, say. The money has flowed into investment, money has flowed into younger and younger founders and CEOs and leaders, and these are all people that are leading massive companies now. I mean, the one you can point to right away is like maybe a Meta. You can point to even Shopify. All these companies that employ thousands and thousands of people, and these thousands and thousands of people have their livelihoods and their lives staked to the success of these companies. They're all led by younger CEOs who haven't dealt with environments that aren't massively favorable to business. Borrowing rates that aren't 0%, so to speak. And so it's just a dangerous environment in terms of what this means. And when people start laying thousands and thousands of people off, as they are in tech, because tech's been so attractive from an employer branding standpoint over the last 10 years for people to go into, you're starting to see kind of the flip side of that coin, which is these sexy industries, of course, and the ones that are flush with cash when times are good are the ones that can pull back hard when times get a little bit more challenging, as they are now. Your J&Js, your traditional kind of consumer packaged goods companies, the ones that have been sustainable for 80, 100 years, so to speak. You're not seeing the massive layoffs there that you are in kind of the high-flying tech stocks. And I think that's indicative of leadership that has a longer-term view, maybe. And it's indicative of a little bit more experience. And so just another thought there as we kind of go into more earnings. I think you got a few more big companies reporting earnings this week that will indicate also, I think it's a lot of the tech companies that are tied, or at least their revenues are tied to advertising. So it's going to be an interesting week to see the current state of the economy, the current state of where ad spend is as a marketer. I think that's important to know, even if you're not in if you're not directly involved, at least with marketing spend. It's good to know the state of marketing from a point of view of our companies investing in that area of their balance sheet or of their operating statement. And so that, it's just good to know. And with YouTube, which is the biggest probably player in this space, showing slowing growth, slowing revenue numbers, I wonder what that means for the rest of the economy.